Hello everyone. My name is Christina Miller, and I am the current president of Society of Government Economists. I'd like to welcome you all here today to our SGE virtual seminar series. We have an exciting presentation planned for you on recent research on federal student loans and policy implications. If you are new to our seminar series, you can find out more about SGE and joining us at our website at sge-econ.org. You can also follow us on X and Blue Sky and Facebook to find out more about our events that are coming up. So just to go over a little bit about SGE. SGE supports the professional development of government economists and economists interested in the economics of public policy. We do this by four main activities. One is our virtual seminars. Two are our conferences. We participate in the ASSA conference in January, and also we have our own annual conference that will be in April. We offer leadership opportunities, which is a fantastic way to meet other people and to gain leadership experience in a nonprofit. So those, we have elections right before our annual conference every year. And then we also offer a variety of networking and mentoring events. So please make sure to join our mailing list or, follow us on social media to hear more. On September 17th, we do have another seminar on the global economic impacts of tariff wars. We are really excited to have Dr. Warwick McKibben from Australian National University come and talk with us. All right. If you are interested in presenting in an SGE seminar, please contact me at president@sge-econ.org. We're always looking for people to present. So I did mention ASSA conference. We have 7 SGE sponsored sessions. We will be in Philly, January 3rd to the 5th in 2026. The preliminary program is up now on the website, the ASSA website. So check us out. And if you plan to be at ASSA, please stop by. We'd love to see you. And then this is just a shout out for a save the date. Our annual conference will be on Friday, April 17th, 2026, at our usual spot so far, which is American University, Washington College of Law in DC. So in December, please keep your eyes out for call for papers, panels, and organized sessions. And that is all I have. I'm going to pass it to Mel to introduce our speaker.
Thank you, Christina. Dr. Monarrez is a labor economist and senior research fellow at the Consumer Finance Institute, where he conducts research on the economics of education and the broader policy implications of development in credit and labor markets. His work focuses on higher education, finance, and local public school systems. His current research provides empirical examinations of the state of the federal student loan program and the structure of higher education markets. Thomas has also done research on the impact of local government policies on U.S. public education and urban spaces. Prior to joining the bank in 2023, Thomas was a senior advisor in the Office of the Chief Economist at the U.S. Department of Education and a senior research associate at the Urban Institute. Dr. Moritz has a PhD in economics from the University of California, Berkeley, and a BA in economics and mathematics from the University of Texas at Austin. There will be a Q&A period after the presentation by a panelist. I hope you will join us for this stimulating discussion. Thank you. Dr. Moritz?
Hi, Oh, sorry, I was muted there. Thank you for the kind introduction. I think everybody can hear me now. I'm excited to present some of the work that I did, as was mentioned, during my stint at Department of Education about a year ago. And so this is going to be a summary of 3 papers on federal student loans and some discussion on the policy implications. And if you would like to interrupt me for some clarifying questions, that is totally fine. I think we will have someone monitoring the chat. And otherwise, if you have some more substantial questions, we'll hold that at the end. Okay, so before I begin here, just a quick disclaimer from the Federal Reserve that the views I'm about to present are my own, and they do not necessarily represent the position of the Federal Reserve Bank of Philadelphia or the Federal Reserve Board, and all errors are my own. So first, I want to provide a quick overview of what are federal student loans, in case you're not that familiar with this policy area. So federal student loans are one of the largest sources of household debt in the United States. The chart on the right here shows some public Department of Ed data showing total outstanding balance on student loans. That's the light blue series here, showing that it has reached almost 1.6 or maybe over 1.6 trillion dollars, up from about half a billion dollars in 2007. So we have been seeing this quite steep increase in the amount of student debt in the US. That has not been fully explained by just more and more people going to college, as is exemplified by here, the number of recipients, right? So we have more and more debt for federal student loans. An important feature of the federal student loan system is that there are little to no underwriting requirements. You don't really have to prove any credit worthiness to get student loans for undergraduate school. And we have had a lot of academics talk about how we have an ongoing student debt crisis, given these massive rise in outstanding balances since the 2010s. So the point of this talk and of the 3 papers that I'm going to summarize here is going to try to understand what is at play here at this student debt crisis, what are the causes and the mechanisms driving. Just a little bit more detail on the federal student loan program. Federal student loans were first authorized by the 1965 Higher Education Act. Initially, they were funded by the Federal Family Education Loan Program. These were essentially private loans that were then guaranteed by the federal government. Since then, we have seen a replacement of this sort of guarantee of loan program and more of direct loans that are issued and owned by the U.S. Department of Education. So the vast majority of the debt now is held directly by the government and not by private lenders. As I mentioned, most of the debt that one can get from federal student loans is not linked to borrower credit worthiness. You won't get your credit score checked before you can get a federal student loan. There's some small exceptions to that. Finally, there's also expanded access for student loans for parents that want to borrow for the education of their kids. That's the Parent Plus program. And this is a little bit outdated now, given some recent changes. I will talk about the most recent changes in policy, but there used to be a program called Graduate Plus that will enable you to borrow as much as you need up to cost of attendance to attend grad school. There's a lot of credit going out to individuals that want to get a post-secondary degree, and they're getting credit directly from the federal government. So what are we going to do in this talk? As I mentioned, I worked as a senior advisor at the Department of Education over about 2 years during the Biden administration. And we were in charge of doing research to try to understand the federal lending program a little bit better. And so here I'm going to provide a quick summary of 3 different papers that we wrote here. The first one is going to be essentially just descriptive. I'm going to be showing you a bunch of charts showing trends in student loan repayment, trying to understand what's in the data there. The second paper here, we're going to show you some of the results from a causal analysis that we had on the effect of macroeconomic shocks, or the Great Recession, that is, on student loan repayment outcomes. And finally, we're going to do a deep dive into a study that we ran on income-driven repayment plans. What are the benefits of income-driven repayment plans and challenges? And I'm going to define what an income-driven repayment plan is. And, this is all going to tie together with IDR. So that's kind of like a preview of some of the themes that I will have. It seems that income-driven repayment has a lot to do with this recent student debt crisis, or sort of mediating a lot of the things that we are seeing in the data. The data that we use in these three papers is all the same. This is all U.S. Department of Education administrative records. They are well observed for the period 2005 through 2019. Of course, we also share the most recent period, but we did have a pause in student loan payments due to the COVID pandemic. And so that kind of threw a wrench into everything here. So we're going to try to ignore that special period by ending most of these analyses by 2019. But we're going to have really exciting data that has not really been analyzed by economists before. These are administrative records from the Department on Loan Servicing, so we know how much people borrowed, where they went to school, how much they owe on their loans still, whether their loans are defaulted and repayment, etc. Some characteristics on the borrowers. We'll also know whether they are currently enrolled in college, and whether they complete college. Obviously, these are important outcomes that we want to keep track of. And we're also going to be supplementing some of this information with the information from the FAFSA, the Free Application for Federal Student Aid. This tells us the income of the family of the student, the gender of the student, where they live, etc. So using this type of data, first we studied just generally historical trends in student loan repayment. So what we did here is essentially just first we go and group student borrowers into different repayment entry cohorts. What's a repayment entry cohort? Typically, it's when somebody finishes and completes their degree, right? But if they don't complete their degree, we just define that as when they last borrowed and then stopped being in school, or the date that they got separated from that college. So if we group people into these different cohorts between 2005 and all the way to 2014-15, and we plot the median repayment rate of individuals that entered repayment at these different dates, and we show the median repayment rate over time, we obtain this kind of picture here, which really sort of summarizes this so-called student debt crisis in one chart. It shows that for people that entered repayment between 2005 and 2007-8, we see a pretty nice increase in the median repayment rate over time. By the 5th year in repayment, so about halfway through the series, folks that entered repayment in 2005 had paid down about 26% of their loans. When we compare that then to people who entered repayment later, say in 2013-14, these are the red lines that we show you here, we see that progress has been way slower. If anything, people were underwater for the first few years. They owe more than they actually borrowed. And then they start making progress in their repayment quite slowly, such that by the 5th year here, only about 5% of that debt have been paid for the median borrower, relative to that big 26% in 2005, right? So this big gap has emerged, and we're trying to understand, why are people not able to repay their student loans anymore? An important thing that I'm going to be driving during most of this talk is there's kind of two ways of thinking about student loan outcomes. One is, were you able to repay your debt? The other is, did you default on your debt? You'll hear pundits talk about repayment rates or default rates kind of interchangeably as like an outcome that we can measure, whether the student loan system is working properly. However, we see that default rates kind of have behaved differently than repayment rates, as shown in this figure here. We have seen more of a partial recovery in defaults than we have seen in repayment rates. So this is a similar picture as I showed you before. This is the average number of months spent in default by repayment entry cohorts, and we see that for 2005 cohort, after 5 years in repayment, about 16% of those borrowers had entered a default. In 2014, that was 21%, right? So we see that indeed, while there were some cohorts that were really suffering, some in 2011-12 cohort was particularly bad. This had a quite quick recovery. By 2014-15, we are seeing levels that are pretty similar to about 2005, and that's not at all what we were seeing for repayment rates. All right, so this is kind of an interesting empirical puzzle that we want to answer with all the data that we have. So the idea here is going to be, why have repayment rates declined by so much? Why have default rates not really followed suit? So here I'm just going to show you a bunch of charts that start to explain this, right? So first, let's look at compositional changes. Here in particular, let's look at educational attainment for our different cohorts that I told you about between 2005 and 2014. Here is whether undergraduates have increased their completion rates, right? So we have the bucket of undergraduate non-completers, a bucket of undergraduate completers. About 40% of our borrowers are undergrads that didn't finish their program. That changed a little bit over time, but not dramatically. We've seen pretty stable composition, at least in this cut of the data. However, outcomes within these groups have changed quite a bit. So if you look at this chart here, now we're looking at the repayment rate, not the share in the sample. Here we have the composition. Now we have heterogeneity in this median 5-year repayment rate. We have seen that for the undergraduate non-completers, repayment rates have really decreased dramatically over time, and that's has gone from about like a 30% repayment rate in 2005 to a -1 in 2014. Non-completers from graduate programs have also seen large declines here. Graduate completers have also seen declines. So it seems like overall, there has been a lot of groups that have declined in their repayment rates, but the worst one being undergraduate non-completers. So that's one cut of the data, educational attainments. The next cut of the data is, did you borrow more, right? We have been hearing about people borrowing a lot of money to fund their college education, and so we can see that bear out in the data, right? So here we just split people's balance that they need to repay as they enter this repayment era. We have seen vast increases in the amount that people borrow, right? So we have this Q4 level of borrowing, or say more than $27,000 total to fund your undergraduate education. That share has really sort of gone up from a quarter, as we defined by the quartiles in the very beginning here, to almost 50% of all our borrowers are borrowing more than $27,000. So there is this quite large increase in indebtedness that we are seeing in the data, and outcomes look pretty bleak for people that borrow a lot of money, right? So this is the average 5-year repayment rate for people that borrow a lot of money. That has now turned negative by 2014. Used to be slightly positive. It's hard to pay down a large debt, right? Interestingly, we have also seen quite a large decline in repayment rates for people that borrow only a little bit, less than $6,000 total to fund their education, right? We think that this is correlated with the folks that are dropping out of undergraduate that really see some of the very worst outcomes, and that is in line with a lot of the literature that is out there. Okay, so that's two characteristics. Here for the final one, I promise there will be only 2 more charts of this style. Here is just the type of repayment plan available, right? So here are compositional changes in the repayment plan that people are using. And while there doesn't seem to me that much action here, there's a clear trend in an increase in IDR. I'm going to explain a lot more what is income-driven repayment. For now, all I will say is that it's a way of trying to make payments more affordable for borrowers with small incomes, right? And we have seen that share of people that select an income-driven repayment plan has really quite increased over this period. If I was able to actually trace this out for a few more years, you would see that would continue increasing. So the take-up of IDR has really kind of increased over this period. And if we look at paydown rates for people in IDR, these tend to be negative, right? Because these tend to have really small payments relative to the amount you owe. There's still an interest accrual happening. So if you're in this IDR program, it's lowering your payments, but it's keeping you in debt for longer. So that might have something to do with explaining some of these trends. So what we do in this paper is just essentially show a lot of these descriptives. It kind of turns into a lot of data, as you can probably tell right now. It's kind of hard to make up our mind of what's actually going on. So then we just take that through a bit of a more of a formal test. But first, let me tell you, in this pure descriptive analysis, we just kind of have the summary of saying, we see that there are giant declines in repayment for undergraduate non-completers. This also correlates with for-profit and two-year public colleges. Didn't have time to show that, but I have some of that in the paper if you're interested. People with small loan amounts are having large declines in repayment. First-generation students are also seeing large declines in repayment. So this is changes in outcomes, right? We also have shifts in the composition of borrowers. We have increases in origination amounts and also large increases in the take-up of the income-driven repayment program. So we have a bunch of things going on. So just to kind of test all of these covariates simultaneously, we run a bit of a more of a formal multivariate test. So we do the Nardo 14 Lemieux reweighting exercise. Sorry, I just misspelled that as DFL. And this is going to suggest that this exercise is suggesting that indeed it is this increase in origination balance combined with increase in income-driven repayment plan take-up that really seems to be contributing to the decline in repayment. And this is kind of rationalizing this puzzle that I had at the beginning of why is it that people are taking so much longer to make progress in paying down their student loans, but they are not more likely to be in delinquency and default. The reason, at least from these sets of descriptive analyses, seems to be or could be that A, you have a really large balance, and B, you have an income-driven repayment plan. So that turns out, the two together sum up to having a balance that is really kind of blowing up over time. But because you are in this repayment plan that sets your payments really, really low, you're not entering a delinquency. You're not entering a default. So you're really kind of seeing a decoupling of the trends in repayment rates and default rates historically. So that's just like a very quick summary of this first paper. This is a paper that's now in the National Tax Journal titled Trends in Student Loan Repayment. I'm happy to share links for that at the end of the talk. So how does that link to how we think about macroeconomic shocks and student loan outcomes? So, just to think a little bit more about the literature that is out there, we see that college enrollment is known to have a countercyclical component. That is to say, when the economy is doing worse, people tend to enroll in college more. When the economy is doing better, we see college enrollment going down. That has been documented in the literature by several scholars. And also there is this literature that is called, the friendly name for that literature is the scarring literature, that says that if you graduate during a recession, that really kind of hurts your earnings long term, right? You end up with a lower earnings profile throughout your career when you graduate during bad economic times. So these two things suggest, right? I've been showing you a lot of charts between 2005 and 2014. Things are getting really bad for student loan repayment during this time. Is it the Great Recession, right? The Great Recession, one of the worst economic downturns that the US has experienced in recent times, started in 2007. It's right in the middle of when things started getting sour for student loans, as I was showing you in the previous set of charts. So to what extent is what we're seeing just driven by the recession, right? Are we seeing are people borrowing more for college because there's this adverse labor market and they'd rather stay in school longer? Is it because during this time we saw a lot more for-profit college enrollment? We saw a lot of rising tuition. A lot of things were happening both because and during the period of the Great Recession that could have explained a lot of the patterns that I showed you in the previous set of findings. So this paper here, what we were trying to do is try to understand to what extent is the student debt crisis completely just attributable to the Great Recession or to economic shocks generally. And among student borrowers, who really bore the brunt of these recessions effects. So for this paper, what we did is we leveraged the design first pioneered by Daniel Yagan to understand the effects of the Great Recession. So we leveraged comparisons in different commuting zones or cities, essentially, that faced different levels of unemployment during the Great Recession. So the map that we're showing here shows this level of geographic variation on unemployment from the Great Recession. And as an example here, circled yellow here is San Antonio, saw only about a 2.6 percentage point increase in unemployment. So we say that the recession here didn't hit that hard. And we compare that to, say, Phoenix, Arizona, that saw a 6 percentage point increase. So they got hit pretty hard by the recession. The idea here is going to be comparing students that were in Phoenix to students that were in San Antonio during the recession and seeing whether their borrowing patterns, their repayment outcomes and the trends in those are different. And if they are, and we can pass this parallel trends test, as you probably know from the diff literature, then we can say, okay, the Great Recession seems to have driven some of these differences between the outcomes of the students. So what do we find here? Just a quick summary chart of this. Essentially, we find that the Great Recession indeed can explain a lot of what we are calling the student debt crisis. So just to put it in numbers, a 1 percentage point higher rate of unemployment during the Great Recession led to 7 to 8% more borrowers and higher outstanding balances all the way to 2019, right? So this is the long tail of the Great Recession. As you know, the Great Recession ended technically in 2009, I believe. So we're talking about 10 years after the end of the recession. We are still seeing some of the effects of that on student indebtedness. So when we look at the student debt data for 2019 and even the current period, we need to have in our mind, okay, a lot of these balances are still balances from people that chose to undertake more post-secondary education as a result of the Great Recession. This chart here is just summarizing one of the outcomes that we're looking at is just total number of defaults in this ZZs, right? So we have log number of defaulted borrowers in Phoenix versus the San Antonio, and we know what type of college they attended. So we can also document which sectors are having worse effects. And so we are seeing here, indeed, we passed the parallel trends test. It doesn't seem to be differential trends in default between areas that got differentially hit by the recession. But then after the onset of the recession in 2007, we see this divergence, right? So in areas that were harder hit by the recession, individuals that attended an undergraduate for-profit 4-year college or a community college, an undergraduate public 2-year college, saw a disproportionate increase in defaults, but defaults increased across the board, right? They just increased the most for these two sectors, but we also saw increases in default for public 4 years, for private 4 years, for all sectors. But we do see that the worst hit here seem to have been the community colleges and the for-profit colleges. In the paper, we run a back of the envelope calculation, and we're able to, these are by sector, but we're able to document that between 10 and 25% of all defaults we're observing in 2019 can still be attributed to the Great Recession, right? So this is important when we're trying to devise ways to address this student loan crisis, is to understand that a lot of what we're seeing seems to be the temporary effect of a pretty large macroeconomic shock. So that's something important to keep in mind. So in this part of the paper, we're just trying to understand these kind of large market level effects on defaults. The second part of this paper is looking at individual borrowers. And so here we study individual borrowers and we group them into 3 different categories. So we have those that were active or they were actively enrolled when the recession hit. We have borrowers that had borrowed recently. about 5 years before the start of the recession. So they borrowed after 2002, but they were not enrolled in 2007. And then we have borrowers that were distant. They had already been in repayment for a while, more than 5 years, are not in college now. They haven't been borrowing from the federal government for school recently, right? And so when we split the borrowers into these three different groups and we start seeing how the effects differ for them, we see that these active borrowers, those that were enrolled at the time, these are young people that are essentially will enter the labor market shortly after the Great Recession. They were enrolled in college in 2007. They are seeing a lot of effects. And in particular, this chart here shows you that they have extended enrollment spells, right? So we see that the recession has a causal effect of raising their likelihood to stay in college for a lot longer than we would expect if they had been in an area that wasn't hit hard by that recession, right? So these are extended enrollment spells, delayed completion. How do you extend your enrollment spell? Well, you need to pay tuition. How do you pay tuition? You borrow more. So the chart here now is showing you just the outstanding balance for these different borrowers, borrower types. And we see indeed the increase in outstanding balance was quite huge for these active borrowers, right? So this is in the order of, $2,000 per unemployment shock. This is an outstanding balance. And we can summarize it also in just the amount that was issued. So it's $100 more in loans per year, per year in the recession. So these are cumulative. So that's why we get these larger coefficients of 2,000-ish. As I mentioned before, we saw extended on enrollment, delayed completion, way higher balances, way higher rates of default, specifically for these active borrowers. We also see that for the recent and the distant borrowers, but it does seem like the enrolled at the time of the recession saw the brunt of these effects. So this is quite in line with the scarring literature that being a young labor market entrant at the start of a recession is really bad. And you're not really kind of avoiding the worst of it by staying in school. At least if you're financing, if you're financing it with federal debt, you're going to have a lot more loans and not necessarily benefit a lot from that. The reason that we can claim, one thing that we can't do here is sort of look at their income, right? I think that's a question that we often get here. Is like, oh, well, maybe these folks are just making a lot of money in the labor market. We can't really say that is not true because we don't have any data on income. The Department of Ed does not obtain data directly from the IRS or anything like that. So one thing that we can see though is IDR, right? IDR kind of shows its head again. And we see that indeed take-up of IDR. So again, income-driven repayment plans are meant to make your payments more affordable, right? So when you have a standard 10-year repayment plan, which is the standard for most of these federal student loans, and you have a larger amount of debt, that's going to result in pretty large payments. We're talking about more than $1,000 per month or something like that, right? So that could be quite unaffordable for a lot of people. So then you can enroll in an income-driven repayment plan to address this. This will set your payments as a small share of your annual income, right? So this isn't solid evidence that these active borrowers are not doing too hot economically, but it is, suggestive evidence that they are not able to make the payments on their debt under a standard plan. They need to enroll in this sort of government relief type of plan, the IDR plan. And we're indeed seeing that they are way more likely, the recession is really kind of having a large effect on these borrowers' likelihood of being in this IDR program. So again, suggests that this divergence in repayment and delinquency outcomes after 2016 can be explained by people joining this income-driven repayment plan in large droves when they are facing harsh economic times. So just a summary of this analysis of the Great Recession here. So the reduced form impact of the recession on student loan borrowing And repayment can really has a large role in explaining the so-called student debt crisis. It really drove a large share of the growth in indebtedness that we see, and it's still present to this day. Those that were enrolled in the recession really bore the brunt of the effects. This really links well with the scarring literature. And, it really seems to be that increase of IDR take-up is coinciding with the decoupling of these default and repayment effects. Okay. So for the last paper that I'm moving a lot faster than I expected. But for the last paper that I wanted to cover here, now let's do a bit of a deep dive into income-driven repayment. So what is income-driven repayment? Let me actually show you how it works. I've been talking a lot about it. People are enrolling a lot. They are using it a lot. So how does it work? So this is an example of how income-driven repayment worked in 2015. So on the x-axis, we have the income of a single borrower, and we have the 150% of the federal poverty line. So that's about $18,000 in 2015. And so the way that these IDR programs worked was, or it actually, yeah, there has been recent changes to this. So I'm trying to think in the past and think in the present here. So this is the way it worked in 2015. I'll talk about how all of this has changed given the recent policy changes at the very end of the talk. But in 2015, the way that this worked was that if you made less than 150% of this federal poverty line, or about $18,000, then your payment was set to $0. That's this blue line, right? So what does that mean? That means I literally don't make a payment and my loan is shown as current, right? So I don't enter a delinquency. I don't get a ding in my credit score or anything like that. But I still have an interest rate on my loan amount, on my balance, and that is going to keep accumulating interest. My debt is going to keep rising because I have a payment of $0. One thing I haven't mentioned is that if you remain in this situation, enroll in this program for 20 years, it kind of depends on which type of IDR you're using, but if you are on the program for a long time, typically about 20 years, the rest of your loans are forgiven, right? So sure, you have a very low payment that is not going to cover interest, or you see a ballooning balance. But if you stay on that program for long enough, which also necessitates that you have quite low income, then you get full forgiveness, right? But the question is, are people staying for that long in these programs or not? That's the kind of thing that we're about to look at right now. So if you make less than $18,000, you're going to have a $0 payment. If you make more than that, then your payment is going to be set to 10% of the money that you make above that amount. So that is this schedule here, right? So your scheduled payment, if you make about $30,000 annualized, your scheduled payment will be about $1,200 or about $100 a month or something like that. And there's a little bit of stuff going on right at the edge there. I probably won't get into all those nitty-gritty details. But the last thing I'll mention is, this gives us kind of a pretty clear threshold for regression discontinuity design if we're interested in studying $0 payments, right? If you make money less than 150% of the federal poverty line, that gives you, technically, according to the rule, 100% chance, that's the right axis here, of having a $0 payment. Whereas if you make a little bit more than that, 18,000, then you should have a 0% chance of having a $0 payment scheduled for your IDR repayment plan. So we're going to be looking at the causal effect of that. But first, let me switch and show you just over time how IDR participation has really grown. I showed you a little bit of that, but it was in an earlier period, right? So I showed you how IDR has increased in take-up between 2005 2014. These series here are from public data from the Department of Ed, showing you from 2013 to 2019 the share of all the debt by repayment plan. So we see that most people or most of the debt used to be in a standard or extended repayment plan. So that's like 10-year or 20-year amortized loan, like a regular loan. Back in 2013, that was about half of all the debt, or a little bit more than half of all the debt. That has steadily decreased over time as IDR has become more and more and more relevant. It has, in recent years, by the end of 2019, reached about half of all of the debt owed to the federal government in student loans is under an income-driven repayment plan, right? So it's about half of the 1.6 trillion that we were mentioning earlier. It's a lot of money. And just to characterize it a little bit more, in 2018, we're talking about 29% of all borrowers were in IDR. About 36% of that 29% had a $0 payment, right? Because they had income below that 150% of the federal poverty line. On average, these individuals were making $27,000 in income. The reason we know is because when they apply for IDR, they need to report their income so that we know what their scheduled payment needs to be. We only observe income for people who apply for IDR, not for all borrowers. So that's kind of a limiting factor there. And they have these folks that apply for IDR, they have really large balances, especially when you compare it to their income. So on average, they're making $27,000 a year, but on average, they owe $60,000 to the government, right? So it's about two times or more of their annual income is their amount of student debt. And this is relative to people who aren't in IDR, who on average would have like $26,000, right? So IDR participants tend to be low income and really high average balance. And take up in IDR has really ballooned over time. Okay, so here's another important detail about IDR is that you need to recertify your income every year, right? So every year you need to, again, this is in pre-2024, pre-2025 speak. These things just changed with the most recent law that passed. I'm about to chat about that, but this is the way things worked for a long time. You had to recertify your income annually. You had to tell the Department of Ed, hey, this year now I'm making $19,000, and we recalculate your scheduled payment, right? If you don't recertify, say you entered IDR, and then you stay for a year, and then you don't do anything, you get bumped back to the standard repayment plan. You don't get to stay on IDR if you don't recertify, right? And so once we understand this part of the nitty-gritty of the rules of how this thing works, we see that really kind of seems to be driving a lot of the dynamics here. So the chart here is just showing you a timeline of IDR participation for all first-time and applicants in IDR. They should say applicants instead of enrollees between 2015 and 18, right? So we have 4 cohorts of IDR applicants. And here we're just grouping them based on the months since they first applied. So what happens? How many of them are on the program? Well, during that first year, when they first applied, during months 0 through 12, a lot of them are in the program. 90% or almost 90% of them are in IDR. They applied for IDR, and now about 90% stay in IDR. That's about 10% maybe chose not to, or something happened. They couldn't enter the program for whatever reason, right? But most of the people who apply are on this like lowered payment plan for a year. But then what happens after month 12 when they need to recertify? See this giant drop, right? This giant drop of about 50 percentage points, right? So by month 13, we're talking about 35% of people who first applied are still in the program. Now that recovers a little bit to about 50% by the end of that second year, but we never get back even close to like a big majority here, right? So it does seem to be that most people that get on this IDR program stay for a year, then about half of them actually stay for a year, and then they drop out, and then they never come back, right? So this is important when we are thinking about the cost of IDR for taxpayers. When we think about the cost of the IDR program, say when like Congress is producing a score or something like that for these different programs, or the CBO is they are thinking about someone staying in IDR for the full 20 years and then getting that forgiveness, right? And then the federal government needs to pay for that full forgiveness at the end. But if you stay for a single year, the federal government's not going to pay for that. So we're not really computing the cost of the program right when we ignore these dynamics in participation. Okay, so in the rest of this paper, what we do is really kind of dive into the effect of having a $0 payment and seeing how it interacts with this big non-recertification effect that we are seeing here. So I'm not going to get into any of the econometrics here, but it's quite intuitive when you're thinking about a regression discontinuity, what is going on. As I mentioned to you, we have this hard income threshold based on the federal poverty line that will determine whether you're eligible for a $0 payment or not, right? So that's 150% of the federal poverty line. So that changes a little bit based on your household size, but as I mentioned, 2015, that was about $18,000 for someone that is single. And so we see that for people that were making less than that amount of money, about 90% and applied for IDR, about 90% of them have indeed a $0 payment, as we would expect based on their income. And then for people that have slightly higher income, about $1,000, $2,000 more than that threshold, very few of them have $0 payments, only about 20%, right? So this shows that our data, while not perfect, right, the theoretical figure I showed you would be exactly at 1 and exactly at 0. We all know there's kind of issues with empirical data. I'm happy to get into some of our theories of why we aren't seeing a perfectly sharp regression discontinuity here. But anyway, we still have quite a large effect of moving from just to the left of the threshold to just to the right of the threshold on the probability that you are on the $0 payment, right? When we're studying the econometrics of this, we try to say your income is as good as randomly assigned across this threshold, right? Like you can't really manipulate your income to be just to the left or just to the right so you can get the $0 payment on IDR. That's hard, and we have evidence in the paper to support that there isn't a manipulation of income around this particular threshold, such that we are in good shape to try to look at the effects of what happens when you have a $0 payment. This paper is all about the dynamics of what happens over time, right? So I showed you at one point in time, I believe this is 9 months after you first applied. So this is when everyone is in the program. But we're all looking at this long-term view, right? So what do we have? So we have 6 months after you apply for the program. We have a large effect. A lot of people with $0 payment when they make a little bit less than that threshold. Very few with $0 payment to the right. Then we have a year after, not much change, maybe things decreased. But when we start looking at that second year, all of a sudden this one kind of stayed the same on the right, but the one on the left, the treated, right, the people who make less money and should be getting a $0 payment, now they're very unlikely to have a $0 payment. They have gone from about 90% to less than 40%, less than half, right? And by the end of that second year, if you squint, these lines are almost the same. Statistically, they're still different, but economically, they're quite similar, at least relative to these others. So what is going on here? Let's plot not whether you have a $0 payment, but just your actual payment amount per month. Per month or per year? Oh, no, it's your annual scheduled payment amount here. So during that first year since you applied, when most people are in the program, we see kind of what we would expect. There's a little bit of noise because of the empirical aspect here, but we replicate sort of the shape of the IDR schedule, right? There isn't that much of a relationship between income. On average, people have about a $400 per year payment for people who make less here. Why isn't this exactly zero? Because some of these people didn't get exactly a $0 payment, right? But we're still replicating that shape that I showed you at the very beginning here, right? So it's recovering that during that first year, this kink. at the end of the year, we're still seeing some of that, but then we see a reversal at the end of that second year, right? So we see, oh, now people that were supposed to have a $0 payment when they applied, they have a higher scheduled payment than those that have slightly higher income and they were not eligible for a $0 payment at first. So it's a complete reversal, right? So these folks that the government was trying to sort of target for relief are ending up in a situation where they have less relief than people that were not targeted for relief, right? So we have higher payment for those that were eligible for zero than for those that were just ineligible. So why is that happening? If I just plot the gap between these, so it's the difference in these payments for them over time, this is just kind of the timeline of those effects, right? So before anyone applies for IDR, there isn't any significant difference. During that year on IDR, those eligible for that $0 payment see a decrease in their scheduled payment. But then after the end of that first year, now they're on the other side. Now they are seeing more money than they had to pay even before they joined IDR, right? So what is going on? It's kind of like they're getting a benefit for 1 year and then they're getting punished for 2 years or more afterwards. So why is that happening? What's happening is that they are falling off of the program. They are, as I showed you in that very first chart, these folks that had eligibility for the $0 payment are way less likely to submit their recertification application at the end of that first year. And so that's exactly what we see in this plot here, is that, everything is fine and dandy during that first year. At the end of that first year into that second year, we see a decrease in the rate of participation for those that were eligible. And we never see it fully recover, right? So it seems like the $0 payment is having a direct causal effect on your likelihood of staying on IDR going forward. So that's quite an interesting finding that we were not expecting when we started looking at this data. And just to kind of complete this picture, to look at default, the effects of having a $0 payment eligibility on default. So this chart's a little bit more complex, but what's going on here is pretty clear to me. So in the pre-period, negative time, no one has applied for IDR yet. No differences in default between eligible and non-eligible borrowers. During that first year, no differences in default. Why? Everyone just joined IDR. When you just join IDR, you can't be in a default, right? Like you enter this new repayment plan, it's like everything is a blank check for you again. You start your repayment progress again, and everyone who applied an IDR is in that situation. Enter the second year. The people who had $0 eligibility, they start falling off the IDR program. They start seeing their scheduled payment balloon up back from zero to whatever it used to be or even more, because there's an interest capitalization thing that happens when you fall off the program. So we see that those that were eligible for $0 payments now are defaulting at a pretty high rate. And that's this decrease in default at first. And then we see that recovery in default. So now we're seeing that now essentially, sorry, I'm kind of stepping all over my words here, is that the protection that these zero eligible borrowers are getting from default is completely temporary. Right? So they get this benefit during that second year, and then they completely catch up in terms of their defaults to the other group. And if anything, maybe they even end up defaulting a tiny bit more. So altogether, what we're seeing in this paper is that indeed these $0 payments are protecting borrowers from delinquency and default, but these effects really fade over time quite quickly. We are not really seeing a significant effect on overall default risk over the long run, as we can see with these kind of effects kind of zeroing out, right? So it just seems like it's a shifting in the timing of when these people might have defaulted, right? So we protected them from default 1 year, but then they default by the second year. So was that worth it or not? The welfare calculations there start getting a little bit complicated. And the reason that we have this only temporary protection effect is because of this IDR recertification issue, right? The $0 payment seems to reduce the likelihood that people stay on IDR, resulting on higher payments over the long run. I didn't have time to show you, but we are documenting that there's quite a bit of heterogeneity across these effects, where with these default protections being higher for people who are likely dropouts, who defaulted prior, who are likely to be Black borrowers. And we have a mechanisms analysis in the paper that we are really seeing, that suggests that we are seeing two mechanisms here. One is an intentional mechanism, right? So why are borrowers protected from delinquency and default? Because we lowered their payment, and now they are able to afford a little bit more in consumption every month, right? But there's this unintentional potential effect that seems to have having a $0 payment seems to have disconnected borrowers from the system. It has reduced the consequences of not paying attention to your student loans. That means you don't recertify by the end of that first year, and then you start seeing all of these bad consequences afterwards. So it's kind of specific about the design of IDR, but really teaches us a lot about how the different challenges and the benefits of IDR. So I'm almost out of time here, so let me just finish here with quick word on policy implication and future direction. So just key takeaways from these three papers. One, we have seen that student loan repayment rates have declined substantially over time. We have seen that economic shocks, the Great Recession, had a persistent effect on borrowing and repayment. It can explain up to like a quarter or a third of what we've seen in terms of ballooning balances and increases in defaults. The reason that we are seeing a divergence in trends between defaults and repayment rates is likely the take-up of IDR, right? IDR, at least the versions that we had during this period, let your balance increase, but it protected you from default, as we saw in the paper here, in the last paper here. So we see this decoupling in recent dynamics and default and repayment that is quite important for policy analysts to kind of have a good handle on. And so indeed, the design of IDR is of key importance here for addressing the student loan crisis. And we just want to highlight some of these behavioral factors that play a crucial role in the design of IDR. And now let me just conclude with a few words on the very most recent changes to policy. So the big bill that was passed during this last Congress session this summer reformed a lot of the student loan program. The reforms repayment plans. It got rid of the concept of $0 payments. So now there are no $0 payments anymore going forward starting next year. So we have some evidence in our paper sort of showing what that might do. There's going to be dual things, right? As we're seeing. It's still going to retain some of these automatic recertification aspects that we saw in the most recent IDR plan from Biden administration, the SAFE plan. So it eliminates $0 payments, but it retains automatic recertification. So our evidence is not completely conclusive on which direction things will push here, but we do think that in getting rid of $0 payments may put some of these lower income borrowers at risk. This latest law has also eliminated this Grad Plus program, so it's really going to limit borrowing for graduate school. And so just some considerations going forward for policy are to just try to balance short-term protections with long-term engagement with the student loan system, accounting for economic conditions, and so these scarred cohorts when we're thinking about repayment policies, and to try to address heterogeneity across different groups in their ability to repay their student loans. Okay, so that is all I had for today, and thank you so much for taking the time to listen. And if you want to have any questions or comments, feel free to send me an email. Thanks.